Right now, Supermicro ticker SMCI, is trading live at $39.08. That's a drop of 3.1% or $1.25 in the first hour of trading, and it is adding insult to catastrophic injury. Most retail investors looking at this on their Robinhood app or SoFi Invest platform just see a small red number on a stock that's already been beaten down. They are completely missing the context. This 3% slip isn't the story. This is the aftershock of a multi-day 30% collapse. The expectation that has surrounded SMCI for 2 years has been that this is the ultimate picks and shovels play for the AI build-out, the scrappy, fast-moving partner to Nvidia stock that would print profits by building the servers that power the future. The reality, which was laid bare just 3 days ago in one of the most disastrous earnings reports of the year, is that the company's business model is completely broken. This stock isn't just falling, it's in a state of free fall, and the market is realizing the growth story it was sold was a house of cards. Let's be very clear about what has happened, because today's 3.1% decline is just institutional funds continuing to liquidate their positions. The general belief, the one that got this stock on every AI momentum trader's buy list, was simple. As companies scrambled to buy AI hardware, SMCI was the go-to. Unlike its sluggish competitors, Dell and HP, Supermicro was famous for its building block solutions, its ability to rapidly design and ship custom high-performance servers packed with the latest Nvidia stock GPUs. They were the agile integrator in the new gold rush. Investors saw it as a high-growth, high-margin tech company, a proxy for the AI boom itself, something you'd add to your Fidelity account right next to your Apple stock for growth. But the reality, as we just found out, is horrifying. On Tuesday, November 4th, the company reported its first quarter earnings. It was a complete and total disaster. Revenue didn't just miss expectations, it collapsed by 15% year over year, coming in at $5 billion when Wall Street was looking for over $6 billion. Earnings were a 24% miss. But the number that has sent shockwaves through the market, the number that explains this 30% crash, is the gross margin. It cratered to 9.5%. Let me say that again, 9.5%. This is down from over 13% a year ago. This is a company that is not only not profiting from the AI boom, it is actively losing its shirt to participate in it. This isn't a tech company margin, this is a failing grocery store margin. The story gets worse. While the company's margins were collapsing, its inventories exploded. They ballooned by $1 billion to $5.7 billion. This is a toxic combination. It means they are building a massive amount of product that they can't sell at a profit. And to top it all off, the company reported a negative operating cash flow of $918 million. They are burning cash at a stunning rate. This is the reality that investors are grappling with. The expectation was a cash printing machine. The reality is a cash incinerating furnace. This is why the stock is trading at $39 and not $60. This is where the story gets truly bizarre and where the bull-bear debate becomes a war. In the very same earnings report that revealed this catastrophic margin collapse, the company raised its full-year revenue guidance to at least $36 billion, up from $33 billion. They claim to have a record $13 billion in back orders for AI systems. This is the ultimate paradox. How can you have record demand and record low margins? How can your back orders be exploding while your quarterly revenue declines 15%? This is the question that analysts on the earnings call tried to get answered, and the company's response was, in essence, don't worry about it. But we know the answer. It's the only one that makes sense. Supermicro is buying revenue. They are sacrificing all profitability to win deals from competitors like Dell and HPE, who have finally woken up and are fighting back aggressively for AI server market share. The 9.5% margin is the sound of a brutal price war. Those $13 billion in back orders? They are likely low-margin, high-cost hyperscale deals that look great in a press release but do absolutely nothing for the bottom line. The company blamed the revenue miss on delivery schedule shifts and design win upgrades, but the market is calling their bluff. The smart money, the traders using interactive brokers trading platforms, read this as a massive failure in execution and a sign of desperation. This is why today's 3.1% drop is so significant. It's not a dip, it's a continuation of the great repricing. The stock has decisively broken below its 200-day moving average, a key technical level that often separates a healthy uptrend from a broken stock. Volume has been massive all week. This isn't retail panic selling on the Robinhood app. This is a stampede for the exits by hedge funds and Fidelity mutual funds that can no longer justify holding a growth company that isn't growing and isn't profitable. Analysts are in a race to see who can downgrade the stock faster. Raymond James slashed their target. Mizuho cut theirs. Bank of America has an underperform rating, which is Wall Street code for sell this immediately. For those who are new to this name, let's quickly clarify what Supermicro does. They don't make the chips. That's Nvidia stock or AMD. They are the assemblers. They take the motherboards, the power supplies, the chassis systems, the cooling systems, and, most importantly, the high-priced GPUs, and they integrate them into a working server. Their claim to fame was being faster and more customizable than anyone else. If a research lab needed a specific server with liquid cooling for a new AI model, SMCI could build it. But that business, it turns out, is being commoditized. And when your primary value add is just speed, you are in a very dangerous position. This isn't Tesla stock, which has a brand, a technology ecosystem, and a supercharger network. This is a hardware assembler, and hardware is a notoriously tough, low-margin business. This is where online investing gets dangerous. A self-investing individual might look at the 30% drop and think it's cheap. They might open their Fidelity investments account and think they're getting a bargain. What they are actually doing is buying a company in the middle of a strategic crisis. This is not a stock for a set-it-and-forget-it intelligent portfolio from a place like Schwab Intelligent Portfolios. This is a high-risk speculative bet that management can pull the company out of a nosedive. This is not investment help. This is a warning. I want to know what you think about this. The company is telling two stories, one of record demand and one of record low profits. Comment below. Do you believe the $13 billion in back orders is a sign of future strength? Or is it a vanity metric to hide the fact that their margins are gone? Let me know your take. So, what is the path forward? The bull case, which is on life support, is that this is a temporary air pocket. Bulls will argue that the company is spending heavily now on new technology ramp-ups, like the Blackwell-based systems, and that these costs will normalize. They'll say that the revenue miss was just a timing issue, and that the $36 billion in guided revenue is the real story. They are betting that management is telling the truth and that margins will recover in the second half of the fiscal year. They see this 39 price as the buying opportunity of a lifetime, a chance to buy the AI revolution on a massive discount. The bear case is, well, it's what is happening. The reality is that the company is in a price war it cannot win. It is caught between giant cash-rich competitors, Dell, HP, and its giant powerful suppliers, Nvidia stock, who hold all the pricing power. SMCI is the man in the middle, and they are being squeezed to death. The balance sheet is deteriorating. The cash burn is alarming. And the high 14% short interest shows that a significant, well-capitalized group of traders is betting this stock will go even lower. They are using their Interactive Brokers accounts to short every week rally, believing this company is a value trap. When you're looking at your Fidelity brokerage account or your SoFi investing page, this is the kind of stock that defines a portfolio. It's a binary bet. It's not like the diversified Fidelity ETFs that offer steady, broad market exposure. It's not even like Tesla stock, which for all its volatility has a physical in-demand product. This is a bet on accounting. It's a bet on whether that 9.5% margin is a one-time fluke or the new permanent reality. So, as Supermicrocomputer bleeds out another 3.1% to $39.08, remember what you are watching. This